It was a pleasure for me to speak on a panel and attend the recent John Burns Housing Summit held in Orange County, California in May 2025. I spoke on a panel on the rising role of non-traditional credit in real estate finance and attended the summit, which is a great gathering, but a small gathering, which makes it quite high value from a relationship standpoint, of many of the top builders in America, many of the top single-family rental owners and providers in America, some of the build-to-rent companies that we have, supply chain vendors, materials providers, the things that go into building a house, and of course, a variety of people that provide debt and equity to enable the creation of housing in America. It's a tough time at the moment for the real estate market. Although fundamentally there's a pretty big undersupply of homes, whether they be apartments or houses in total in America, estimated at something like 3 or 4 million by Freddie Mac. The reality short term is we've had fairly limited supply across most markets of America, although now there is increasing divergence where there is increasing supply of existing houses in certain markets, such as Austin and Denver and parts of Florida. And there's continued very tight supply of housing in other markets, such as ones in the Northeast and the Midwest, and markets like even Buffalo, New York. The builders were concerned in the sense that April and May traffic had been lower. April numbers were available at the time that we met. And there's usually a spring bounce in housing. The builders had not seen as much as a big spring bounce as they were hoping for 2025, and as we were all hoping. We were hoping that we would be in stable market conditions, that rates would be coming down, that affordability would be going up, and that all parts of housing would be benefiting from the tailwinds that are created fundamentally by that lack of supply of housing. That being said, rates had moved up, causing increased affordability challenges since Liberation Day rather than things going the other way. The tariffs had caused some concerns about rise in input costs, and the immigration policies that have been implemented were causing some concern about potential labor issues. Now, the interesting thing was that none of these issues were seen as major deal breakers by the industry. For instance, most people said they haven't actually yet seen an impact of the immigration policies on labor shortages. And they attributed some of that to potentially a transfer of labor from the multifamily sector to the single-family sector, because there's been a decline in multifamily starts over the last 12 and 24 months. So instead of there being, even if there was an aggregate marginal reduction in labor, the shift from multi to single family has created a dynamic where there's no labor issues that people talked about yet, although they were concerned about potential visa challenges coming up with issues with renewing visas and things like that in the future. On the input cost inflation front, we saw that the estimate of total potential increase in costs had gone down to the low single digits, like the 2% range from the 5 to 7% range originally when the original tariff policies were announced. And most people thought that there might be a little bit of an increase in cost, but that they thought they could manage that through a variety of strategies, including changing suppliers, looking at American suppliers, looking at maybe going direct to manufacturer, and things like that. So there was definitely a short-term focus. People did see first-time home buyers severely affected because of rates and lack of affordability of getting into a home, both in terms of the house payment, which is now substantially higher than a rental payment, and also the pretty substantial down payment that's required, which is many years of savings for most first-time home buyers. They saw more health in the move-up buyer, the folks that are in their 40s and 50s and 60s, and that already had a house that they owned before, that built up equity over the last couple of decades of very low rates, and that now actually are able to afford the move-up house or the change in house due to a life event by affording the down payment and not requiring as much debt, so that the high interest rates are affecting them less. So where maybe a year or two ago there was more strength in the first-time home buyer segment, in 2025 the theme was that the above 55 and move-up buyers were a stronger segment and first-time home buyers were weaker. People did see challenges because of the high mortgage rates and some of the other challenges that I talked about, whether it be labor or supply. They saw a reduction in their margins coming, and most people were planning to marginally lower their rate of housing starts, although they were not planning a dramatic change because of the long-term tailwinds and the long-term needs of the housing market, where we need to catch up and not only build a number of houses to support the number of household formations every year, but catch up and build those 3 to 4 million that I stated earlier are missing from the housing stock. In terms of things going forward, what it means for real estate finance in the housing sector is that we are facing some near-term road bumps. They're not going to be catastrophic, but they're going to require some short-term changes in both how people operate and the type of product that they create and who they serve. There might be an increase in rental housing strength relative to ownership housing very near term because of the high cost of financing that's been mentioned. But everybody felt pretty optimistic about the long-term dynamics in the real estate markets and the housing finance market. Although there is a pretty big shift happening where banks are slowly retreating and there is an increasing role of non-traditional capital and private capital, which is the space that Anchor and many of our competitors and peers support. And I really enjoyed the panel that I had with Beth O'Brien and Arvind from Kiavi, because the truth is that we together form the industry that serves the housing market and America's needs, and none of us can do it alone. And there's so many areas for collaboration, even as we compete within our segments of market that we focus on. Thank you very much. That's the quick update from John Burns. Look forward to sharing future updates from other similar events as the housing market continues to be very dynamic and we continue to be in a fairly uncertain and change-oriented environment, especially in the near term.